Global markets have always reacted with a mix of curiosity, caution, and speculation to developments surrounding the Iraqi dinar because Iraq represents both a story of massive untapped oil wealth and a fragile political economy, and every update from Baghdad, whether it comes from the Central Bank of Iraq, CBI, the Ministry of Finance, or international partners such as the IMF, ripples across trading forums, investor chat rooms, and regional financial institutions that are seeking to understand whether the dinar will one day evolve into a stronger, more internationally accepted currency or whether it will remain pegged, limited, and largely confined within Iraq's borders. And in this process, the reactions of global markets tell us not only about Iraq's currency but about the psychology of speculation, the mechanics of oil-dependent economies, and the ways in which emerging market currencies are interpreted in a world dominated by the US dollar, euro, and other reserve currencies. Historically, the dinar has been undervalued relative to Iraq's enormous oil reserves, which are among the largest in the world, and this discrepancy fuels constant chatter in speculative markets, especially among retail investors in North America and Europe who purchase dinar banknotes in the hope of a future revaluation that would yield life-changing returns. However, when professional analysts, banks, and financial institutions react to Iraqi dinar updates, they interpret them through the lens of macroeconomics and central bank behavior rather than miracle scenarios. For example, when the CBI devalued the dinar in December 2020, adjusting the peg from about 1,190 per US dollar to 1,460, global markets did not celebrate or panic, but instead assessed the move as a rational response to declining oil revenues during the pandemic, a step that preserved foreign reserves and allowed the government to balance its budget. In bond markets, Iraqi sovereign debt yields reflected the increased fiscal pressure but also showed that Iraq had room to maneuver thanks to its oil exports, and in regional banking systems, particularly in Jordan, Lebanon, and the Gulf, the adjustment was understood as part of a wider set of austerity measures rather than an indication of collapse. Similarly, when the CBI readjusted the exchange rate to 1,320 per US dollar in February 2023, following political change and strong oil revenues, global markets reacted by noting that Iraq was under pressure from both domestic inflation and U.S. scrutiny over dollar outflows, and therefore the stronger dinar peg represented a compromise designed to restore some purchasing power for Iraqis, while satisfying international partners that Iraq was taking monetary management seriously. In this sense, the global market reaction is not about speculation on sudden riches, but about measuring whether Iraq remains stable enough to service debt, honor contracts, and maintain oil flows. Investors in oil futures pay close attention to dinar updates because they know that Iraq's ability to defend its currency depends on oil revenues. If currency moves suggest fiscal stress, oil export commitments may be strained, which in turn influences futures pricing, while currency stability reassures the market that Iraq can continue as a reliable exporter. In the foreign exchange community, however, reactions are shaped by the persistent myth of a global currency reset. Retail speculators who believe in a massive revaluation interpret every central bank update as a possible precursor to overnight gains. So when the CBI talks about redenomination or tightening auction rules, chat forums explode with interpretations that this signals an imminent shift to a one-to-one parity with the US dollar, even though professional analysts dismiss this as unrealistic. The divergence between retail reaction and institutional reaction is stark. While small investors see opportunity in rumors, global banks, rating agencies, and multilateral organizations see routine monetary policy. Another area where global markets react is compliance and regulatory reform. When the U.S. Federal Reserve began pressuring Iraq in 2022 to 2023 to tighten controls on dollar outflows and prevent illicit transfers to Iran, Syria, and other sanctioned entities, the CBI responded by enforcing stricter auction rules and limiting access to dollars, which created volatility in the street exchange rate inside Iraq, but reassured international regulators that Iraq was aligning with anti-money laundering, AML, and counterterrorism financing, CTF, standards. In global markets, this was viewed as a positive step because integration with the global banking system requires compliance, and each CBI announcement in this area is interpreted as movement toward or away from financial modernization. In equity markets, particularly in the Middle East, updates about the dinar influence perceptions of Iraq's broader investment climate. A stable dinar peg makes it easier for foreign investors to commit to projects in Iraq's oil, construction, and telecom sectors, while rumors of instability or uncontrolled devaluation make investors hesitate, fearing capital flight or profit erosion when repatriating earnings. Thus, central bank moves that reinforce dinar stability are often followed by modest increases in investor interest, while moves that weaken the dinar trigger cautious wait-and-see attitudes. Another layer of global market reaction is geopolitical. When Iraq signals through dinar policy that it is aligning more closely with the US dollar system, markets read that as a sign that Baghdad is maintaining ties with Washington. When discussions emerge about Iraq joining de-dollarization blocs or strengthening ties with China by conducting oil trade in yuan, markets interpret this as part of a larger geopolitical rebalancing that could influence oil pricing and currency flows, though in practice Iraq remains tied to the dollar due to its oil trade structure. Speculators outside Iraq also track updates from the IMF and World Bank regarding Iraq's currency, since these institutions periodically release reports praising or criticizing Iraq's monetary management. When the IMF supports Iraq's peg adjustments, global markets interpret that as a green light for stability, while criticism can cause investor hesitation. One of the recurring themes in global market reaction is the misunderstanding between redenomination and revaluation. Professionals know that redenomination, removing zeros from the dinar, does not change value but merely simplifies accounting, while revaluation means a genuine increase in external value, which is economically implausible at the scale speculators dream of. Yet, each time Iraq hints at redenomination, retail markets react with frenzy, buying more dinar banknotes from dealers at inflated premiums while professional markets barely move, understanding the limited significance. The psychology of reaction is therefore an important part of the story. Global institutions react with measured analysis, while speculative communities react with emotional excitement. From a macroeconomic perspective, what dinar updates mean for global markets is primarily about risk perception. Stable currency management lowers perceived risk and makes Iraq a more attractive partner in oil and reconstruction contracts, while instability raises risk premiums and limits Iraq's integration. In the long run, if Iraq continues to modernize its financial system, enforce compliance, and diversify its economy, the dinar could strengthen modestly, and global markets would react by upgrading Iraq's credit ratings, lowering borrowing costs, and increasing investment inflows, but none of this would occur as an overnight revaluation. The 2020 devaluation and 2023 revaluation episodes show how sensitive markets are to signals. Global bondholders demanded higher yields after devaluation but stabilized after oil revenues recovered, while regional investors paused during volatility but re-entered once the peg stabilized. For oil importers like India and China, updates on Iraq's currency policy matter because they influence how oil contracts are priced and paid. A weaker dinar can allow Iraq to manage budget needs while keeping oil attractive, whereas a stronger dinar can reflect stability but also tighter margins. In the end, global markets react to Iraqi dinar updates not by buying stacks of banknotes in the hope of a jackpot, but by recalibrating their models of Iraq's fiscal health, oil production reliability, and integration with financial norms. And the consistent theme is that Iraq's currency story is one of cautious adjustments and survival, rather than miraculous transformations. The fiction of overnight revaluation dominates retail chatter, but the fact of measured central bank policy shapes institutional market reaction. For investors who want to understand reality, the key is to watch the CBI's moves in the context of oil, politics, and global regulatory pressure, because those are the factors that genuinely move markets, and every time the dinar shifts by a few hundred points against the dollar, global analysts note not a coming windfall but a reflection of Iraq's ongoing balancing act between domestic needs and international demands.